I think the same rules applied 50 years ago, applied 5 years ago, apply 20 years from now. First of all, you have to know what you own, whether it's a fund or a stock, and you have to have a reason for it. And you ought to be able to explain to an 11-year-old in 2 minutes or less why you own this. And this sucker's going up is not a good reason. I've tried that one. Doesn't work. Well, basically, you look now, you have 3 choices. I think if you're an investor, you can put your money in a money market fund and get 1.7, 1.5, 1.6, and it's taxed at a 40% rate. Or you can buy a 10-year treasury and get 4.7, and that's taxed at a 40% rate. Or you can have some equities. And I think stocks over the next 10 years will do a lot better than 4.7 or 1.7. So I would have some of my money. Now, it's up to the person to decide how much they want to have in the stock market. For some people, 10% is aggressive. For some people, 50% is the right amount. It's a personal decision. And you can't go by these rules that if you're 25, you should be 100%. And if you're 45, you should be 50%. And if you're 60, you should be 0. And I guess burping a lot. I don't know what the rules are on people at 60, but I hate those rules. I think they're pathetic. They're not lottery tickets. I mean, when you own a stock, it's a share of a company. And I think companies are going to make a lot more money in 10 years, a lot more money in 20 years. And that's why they go up. That's the only reason. Some companies don't do well. Zero Huxes make a lot less money than they did 30 years ago. It's a lot less. Well, I think not looking at the balance sheet, and this is a mistake I've made. If you look at a person's balance sheet, you look to see what the assets they own, their houses, if they own a house, if they own a car, what debt they have, and take that away. That's what your net worth is. You should do that with a company. And I've seen investors look at companies that made, let's say, looking at 2 companies, they're very depressed. They're each at $4 a share. But one company's, and they're each losing a couple $1 million a quarter. One company is $100 million in cash and no debt, and one company has no cash and $100 million in debt. They're about to blow taps on the second company. So and you could do this. If you get through 8th grade math and you get anywhere near 8 and 8 equals 16, you can do this. Look at a company's financial position. It's impossible to go bankrupt if you don't have any debt. I mean, you get the Irving G. Thalberg Lifetime Achievement Award. I think they're bad management. I mean, how could you do that? Well, I think my greatest mistakes were, I mean, it's funny, in a stock, all you can lose is 100%. I've done that. And your great mistakes is selling a good company, and then it doubles, then it triples, and it quadruples. Because you make a lot of mistakes, and so those ones that go up tenfold, I call them the 10 baggers. So some of my mistakes are just saying, oh my God, this stock is too high, and I was wrong. And you had to figure out, what inning am I in this baseball game? I sold Toys R Us way too early. It went up 20-fold after I sold. I did the same thing at Home Depot. Those are probably my 2 greatest mistakes I ever made. Well, you ought to find out why you bought a stock. If you're saying it's a cyclical company and they're doing poorly and they're doing awful, you wait till things are getting better and they're doing terrific, and then you sell it. But with a growth company, you have to say, Walmart's case, 10 years after they went public, you could have bought the stock and made 500 times your money. You say, still are only in 15% of the United States. And they could say, why can't they go to 17? Why can't they go to 19? Why can't they go to 23? So for the next 4 decades, they went around the country. So you have to say to yourself, in this stock, I have a 10-year story, a 20-year story. You ought to be able to write that down and follow that. That's what I do with the company. And that's your decision. That's how you sell it. No, you still buy a company, and you buy a company to grow. And if it's a textile company or it's an electronics company or a software company, you better understand what they do. And if they do well, the stock will do well, no matter what happens to the market. If the Dow Jones today was 1,000 or 500, you would have made a lot of money in McDonald's. You would have made a lot of money in Johnson & Johnson. You would have made a lot of money in Gillette. These companies' earnings have gone up a lot the last 30 years. And if the market was 50,000, you would have lost money in Burlington Industries. I recommended that in 1969. I think it's gone from 34 to 2 with no stock splits because their earnings have been terrible. This is a funny business. You don't have to be right even 5 times out of 10. If the times you're right, you make a double and triple. It offsets all those times you lose 20 or 30%. So when you buy a stock, you ought to say to yourself, how much can I lose and how much can I make? And you ought to be able to make a lot. Stocks are risky. I mean, look at how much we lost in AT&T. Look how much we lost in Xerox. These were quality companies. You can lose a lot in a stock. So you got to say to yourself, how much can I make? Because I want to buy a stock, if I'm right, I'm going to make a double or triple. So you have to be careful. I'm looking at companies that are selling close to cash. They're an industry leader, and they're down 95%. Well, I think also what they have to say, what do I want? Do I need the money in a year? Do I need the money in 5 years? You're a terrible investor if you need the money in a year. I mean, if you need it for college, to send your kids there, or for a wedding, you're not going to be a good investor. Then you have to do some homework and say, should I have 10 growth funds? That's silly. You say, what do I want? I want 2 or 3 growth funds. What's my mix I like? And you want to say, is aggressive. For some people, aggressive is 50%. So I would say people, and some people might want to have foreign funds. It's like a menu at a restaurant. They should look it over and decide what they like, and then stay with it. And if one group does well for 2 or 3 years, the next bunch of money they add to, maybe they should add to the group that's underperforming. Over time, different categories work out to be about the same. So you get whipsawed. If you're all in one area, it does poorly for 3 years, you say, get me out of that, and you go into some other area, and that does badly for 3 years. You could be in it forever and never make money. I think you ought to see some kids, hire an 8-year-old, hire a 6-year-old, just watch them. They don't know who Alan Greenspan is. They know about the shape of the yield curve. They're optimistic about the future. we'll be fine for the next 30, 40 years.